Hi everybody, Ben Hart here. It's Friday, May 12th. So I'm recording this a little bit early. I'm out west at have a friend's wedding tomorrow. So out doing that for the next couple of days. So I hope everyone's doing well. We're going to jump in. Lot happened and went on this week. So just going to jump into some of the charts, some of the things I saw happening, and really cover kind of the State of the Union and see where we are. So just bear with me for a second. I'm going to launch into the presentation. Okay, so we are May 12th. So lots going on this week, and certainly the central banks continue to take center stage. U.S. Treasury Secretary Janet Yellen talking about what's going to happen with the debt ceiling. We had a new CEO announced from Twitter today, where Musk announced Linda from CNBC, I believe, is joining to be their CEO, and he's going to take a step back and change and focus his direction on product development and technology. But really, I think from an economic perspective, what really matters is just where we are. Where's the consumer at, and where are things progressing along the view that I've been talking about now for some time, is I think we're in a recession already. And so what happens next? And this chart really jumped out at me today, and it says effectively more insolvent Canadians. We've jumped up to a record high, and so this is obviously a material move. So when people ask me how is it that the market prices in rate cuts in Canada, and this would be one of the screaming reasons as to why. And so as we look at this kind of data, this is why I think rates are going to come down, and probably not sooner than people expect. So that was the Canadian data. So this is a little bit on the U.S. side. So this is for housing in the U.S. So University of Michigan puts out quite a bit of excellent economic forecasting, and so this is buying conditions for houses. So really, it's a gauge to say how easy or not easy it is for an individual to buy a home. And so as we look at this, we're looking at the last period. It was this difficult to buy was in the mid 80s when rates were at a much different level. I think when I spoke on the weekly a few weeks ago, I was talking about, we got 4 times debt level that we had in the 80s. And so if you go 4 times 5% right now, so similar, this is a good view to see that the financial conditions are similar to like they were then. And so really difficult for people to buy homes. And so of course that has an impact and a material trickle down into the economy. And so I've been talking about bonds on and off for 18 months probably now. And so as we look at historically, I always like to look back what happens when we have these kinds of events where we get a correction where rates tighten quite quickly, bond prices correct. What happens on the other side of that typically? And so it's just a pretty great chart to just see, when you have material drawdowns like we did here and here, you had pretty nice returns coming out of the other side of that. And so I think that's a function of both kind of an overreaction to one side and also a view of what's to come with the economy. I also like to look at fund flows. It's been something that you pay attention to, and I've certainly paid attention to in my career, which effectively this is a view of it. And so as you start to see material outflows out of equities, and I meet and speak with wholesalers every week, and these wholesalers are people that see where funds are going in and out. I always like to ask the question is, where's money going and where's money not going? So it gives me a pretty reasonable gauge, depending on the companies I'm speaking with, where the money's going and where it's not going, to get a sense of what are investors doing and thinking, because there is oftentimes that there's a natural instinct to sell at the bottom and buy at the top. And so right now, as we came into the last 12 months or so, we've had material selling on the equity side, which is also tends to be a reasonable sign of a bottoming process. And so that's another positive that I'd look at there. I haven't put this chart up in a while, but it's been the first time in a long time where we've seen, at least on the stock side of things, this is Jeremy Grantham with GMO. So he always puts out his forecast. This is a 7-year forecast. And Jeremy's based on valuations, his view anyways. And so this shows based on valuations that, we got a lot of things on the positive side here over the next 7 years. And so it's a reasonable period to look at what the expectation is and where the potential opportunities are. And so the last one, I'll leave it at this is, as I start to think about the cycles, I talk often about macro, and Hedgeye puts out tremendous research that I use to get an idea of where we think the macro is going. And, nothing's materially changed there. We still think growth is slowing and inflation is slowing, which is an economic view. And so stocks tend to bottom and or top as those views change. And so as we went into last year, when I said, for example, it looked like the first 2 quarters would be a contraction. Tech was bottoming, it looked like at that time, and then suggested maybe looking at a company like Meta, for example, of something that you'd want to buy in that period, with the view that as we get to where we are today, you get a reasonable return. Well, Meta's up about 50-60% since then. And so now as we start to come to the other side, where I start to think that the economy looks like we are in the recession and we're starting to bottom, the consumer is stretched, there's a number of pieces that are continuing on the move. I say, well, what's on the other side of this, and how do we position for that, and when's a good opportunity risk reward wise? And so Hedgeye puts out their research long short ideas. I mean, these are great from a perspective of what are they like from evaluations, what are they like from the fundamentals. And so I'd look over here on their long ideas page, and I would say, what also lines up with what I think is a good potential entry point. And so we look at a company like Capri, and Capri's discretionary, consumer discretionary holding, and or Nike. And as these companies start to bottom, you'd look at them and say, maybe this makes sense as a pretty good risk reward at this point right now. And those would come into the place where I'd start to say, maybe I want to buy them with the view that they've come down about 50% off their highs. The consumer stretch, things probably are going to look like rates get cut at some point in the future, and these offer a pretty good risk reward with that point of view. And so where do I think we go from here? I think things continue on the path that I've been talking about now for quite some time. Things are going to get better, I believe, at least in the second half of this year. I do think rates come down, so you want to own bonds, but also start to think about deploying in some of those names, like I mentioned, Nike and Capri. And so that's what I'd be doing right now. We'll go back to our regular schedule next week. If anyone has any questions, Renaud's been sending out emails or booking reviews right now. So if you need something, please feel free to shoot her an email and we'll book a time. And we've also been updating our files. So she has been sending out some documents to people as we try to make sure everything's up to date and noted properly. So if you do see something come through your email from Renaud, please have a look and sign it. And yeah, if you have any questions, give us a shout. But thanks, everybody. I hope everyone has a great weekend, and we'll see you next week.